BYD's Q1 report landed. Short-term debt went up to $9.7 billion. That number had grown 72% in 90 days. At the same time, profit and operating cash flow fell more than 50%. Nobody in the room asked why.
Yes, and the pressure was already visible earlier. Let's look at the financial DNA of this decline. In 2025, the company was still reporting revenue growth, even as profits started to slide. They were selling more, but keeping less. But by Q1 2026, the wheels came off. For the first time in 6 years, revenue and profit crashed simultaneously. A 55% drop in profit isn't a dip, it's a free fall.
That is an ugly combination. So don't tell me the $10 billion debt was borrowed for normal growth funding. This looks more like it is borrowing to keep the machine alive.
Yes? And the company was not only borrowing from financial institutions. In effect, it was also borrowing from its dealer network. Across China's auto market, dealers were screaming about the same disease. Inventory dumped on them, sales targets pushed beyond reality, rebates arriving late, and cars stuck in the channel before real buyers absorbed them. Its dealer inventory was reported at 3.21 months, while the industry average was only 1.38 months. That is more than double the market average. For a dealer, inventory is not just stock, it is trapped cash. The dealer still pays financing costs, rent, salaries, and showroom expenses while waiting for those cars to move. If prices fall before the cars are sold, the dealer bleeds margin before the customer even enters the showroom. The company's sales machine may have pushed more pressure into dealers than they could survive. In Shandong, BYD owners got a warning. A major dealer group, Qiancheng Holdings, collapsed. At least 20 stores were reported shut or deserted. More than 1,000 customers were affected, including disruptions to warranty and after-sales service. An EV depends on a support system: battery warranty, software support, parts supply, and service access.
Was Qiancheng just bad management, or was it the first visible crack in BYD's sales channel?
Nobody admits this kind of game in public, but the pattern leaves clues. That is the ugly part. Industry reports describe dealers being pushed to take slow-selling models just to receive quota for hot-selling models. The factory protects its volume by moving unwanted stock into the dealer channel, while the dealer has to use whatever margin it earns from popular models to absorb losses from weak ones. That is not clean customer demand. That is pressure being transferred downstream. Then comes the even uglier practice: zero-mileage used cars. Brand new vehicles are sold as discounted second-hand cars to clear unsold inventory. China Dealer Chamber urged automakers to stop dumping excessive inventory onto dealers. The chamber warned against forcing dealers to stockpile cars, called for more reasonable sales targets, and urged shorter dealer payment cycles. Even state-run People's Daily criticized the practice for disrupting market order and inflating sales data.
Bundled allocation and zero-mileage cars sound less like a business and more like a hostage system. Is that all for the borrowing of the company?
When dealers could not provide enough cash cushion, the pressure moved upstream. BYD leaned harder on suppliers, using unpaid bills as a shadow financing layer. It took 127 days to pay suppliers compared to the industry average of 108 days. 127 days is effectively a 4-month interest-free loan from suppliers. To make it worse, it used an internal note system, basically IOU notes in layman's terms, where some payments were not due for as long as 1 year. With these IOU notes, the supplier gets a promise to be paid later. If the supplier needs cash today, it may have to take a discount, sometimes around 6%. So the company keeps cash longer, while the supplier carries the pressure first. The pressure became serious enough that China introduced rules requiring large companies to settle supplier payments within 60 days. For suppliers, that is protection. For the company, it removes a cheap cash cushion.
So BYD is squeezing cash from every corner. If they can't pay suppliers, who is financing the next launch?
In the short term, the banks. But look closer. This pattern, using debt to hide a lack of profit, is the exact same architecture used by China's local government financing vehicles to hide a $9 trillion hole in the national balance sheet.
Wait, are you saying it isn't just a car company? It's a debt management tool?
That is a conversation for another day. But for the owner of a BYD today, the immediate risk isn't the national debt. It's the parts warehouse.
That is not the picture of a company expanding comfortably. Let's look at overseas. Sales jumped 70.9%. On the surface, that sounds like a victory. However, as a China car maker, the company did not directly disclose China sales.
Yes, simple math is enough to tell us something alarming. Overseas grew strongly. The implied China passenger vehicle business fell much harder. Overseas added about 56,000 vehicles, while implied domestic sales fell by about 114,000. The core weakness was roughly twice the overseas gain. If the home market is healthy, overseas growth is expansion. If the home market is weakening badly, overseas growth is no longer just expansion. It becomes damage control.
Do we have other data showing the pressure is getting worse?
Yes, as sales weakened, production also fell. In Q1 2026, output dropped by about one-third. Reported shift reductions and idling of some production lines followed the sales slowdown. Headcount was also cut. For the first time in company history, its workforce fell by roughly 100,000 people. But it cannot defend itself by cutting costs alone. China's EV market has too many aggressive competitors.
Is that why it is so aggressive with its lineup? Minor updates every year and full generational replacements in less than 2 years. BYD and other Chinese automakers have been described as developing and launching new models in as little as about 18 months, compared with roughly 5 years or more for legacy automakers. Do these R&D efforts actually pay off?
A car is not a phone. It is an expensive asset financed over years. If models update too quickly, buyers start worrying that today's car will be outdated, discounted, or replaced by next Christmas. This creates a demand-death spiral. Buyers wait for the next update, dealers choke on inventory, discounts deepen, and buyers wait even longer for prices to bottom out. Speed doesn't guarantee growth. It could create a crisis of confidence. The company reportedly pushed around 200 over-the-air updates in 2025 across its Ocean and Dynasty model lines. That sounds impressive, but it also raises a buyer question. How much of this is innovation, and how much is constant correction after the car is already sold? A car is not a phone. If the ownership experience depends on endless updates, buyers deserve to know whether they are getting a finished product or a moving target. The company uses a very specific slogan that has become a cornerstone of their branding. Safety is the greatest luxury. Looking at the 200 software updates, it sounds very ironic. And speed is not free. The company spent almost 8% of its revenue on research and development, almost twice its net profit. However, its China market share has fallen from its 2024 peak of 34.1% to 22.8% in March 2026. At this scale, fast launches aren't a sign of strength. They are desperate attempts to stay relevant.
Is the market weakening? Can't Beijing keep the EV machine alive with subsidies?
It can support the market, but the support is changing. For 2024 and 2025, qualifying new energy vehicles could receive purchase tax support capped at around $4,200. For 2026 and 2027, the cap is halved to around $2,100. That is still support, but thinner support. For price-sensitive buyers, that difference matters. Nearly half of all sales come from the budget category. These are the cars most affected by the price war and the ones that provide the smallest profit per unit.
China has been building this EV giant. The government support should continue to last. That is what most people believe.
Not really. China has its own financial problems as well. In June 2025, at least 6 cities and municipalities paused subsidies after initial funds were depleted faster than expected. China's EV market did not grow in open air. It grew inside a 17-year policy greenhouse. China has been incubating companies since 2009. Direct subsidies started in the early pilot years. Then came purchase tax exemptions, local incentives, license plate advantages, trade-in programs, cheap industrial land, and supply chain support. The national purchase subsidy ended in 2022. Now, BYD is facing unprecedented challenges in China. EVs are excluded from the next strategic industry list. I don't mean China is abandoning EVs, but the tone has changed. Beijing is quietly telling the industry, survive more on your own. For the company, the easy phase is over.
It must have noticed the trend and started to establish their footprint overseas. However, we always hear about tariffs and countervailing duties. How hard do they hit the company?
It depends on the market. The U.S. tariff on China EVs is 100%. That is not a tax. That is a wall. Once you add politics, data security fears, and connected car rules, it is basically closed for China passenger EVs. The company is doing well in the UK, Australia, and Brazil. The UK has the normal car import duty, but it did not copy the EU's 17% anti-subsidy tax. Australia is even more open after removing its 5% EV import duty. Brazil is different. Brazil is a growth market, but it is raising import tariffs toward 35%. We definitely see growth beyond China. But let's recall the figures just now. For every vehicle gained overseas, the company lost 2 at home. It needs to work harder to offset internal decline.
If I am considering buying a BYD or I already own one, how does the 10 billion US dollars debts translate to my experience? The question is no longer whether the company is under pressure. The question is, who absorbs it first?
When you buy an EV, you are buying an ecosystem. You might not deal with the company directly, but your service centers need the company to reimburse your warranty claim and supply them the spare parts. Both you and the service center depend on the company's technical support, troubleshooting tools, diagnostics, and software updates. When a company is under pressure, the risk is not that everything disappears overnight. The risk is slower execution. Warranty claims take longer, parts wait times stretch, service centers get overloaded, and overseas customers feel the distance first.
Is there anything else the market would react and feel more quickly?
We discussed how the price war and rapid product launches may be draining the company's profit and cash flow. All these would reflect in changes in price for both new and used cars. Let's look at one of its best-selling models, Atto 3, also known as the Yuan Plus in China. China shows around 46% 3-year retention for a used Atto 3. Malaysia listings imply roughly 42 to 50% retention. Australia looks stronger, with around 64% retention. But the warning is still real. You bought an asset. The warranty says 8 years, yet in some markets, the resale data says that asset can lose nearly half its value long before the battery warranty ends. In another example, the 2024 Glory Edition can be about 12% cheaper than the previous 2022 generation. When the company cuts the price of a volume model, used owners feel it immediately. Their car is not only competing with other used cars, it is competing with BYD's own cheaper new car. Your car gets hit twice.
So the BYD bubble is not just about whether the company survives. It is about where the pressure goes. That 10 billion US dollars debt does not stay inside a spreadsheet.
Every discount is a confession. Every delayed payment is a transfer of risk, and when the machine finally stops, it is not the factory that pays the price. The car may be cheap to buy. The system decides whether it is cheap to own.